Hi there, I'm Lynne Richardson. I'm the Dean of the College of Business here at the University of Mary Washington. And today, in our continuing quest to go online and share with you information, we're going to do Money Matters, the third installment online. So first, 2 weeks ago, many of you attended the insurance talk with Kurt Riesbeck. It was face-to-face the night before the coronavirus took over our lives. And then last week, Professor McCondy talked about budgeting. And so today, I'm going to take some of the things that Professor McCondy talked about and teach you more about loans, credit cards, credit scores. Because these are things that, in talking to students over the years, I'm learning a lot that most students don't really understand loans and credit cards and credit scores, perhaps because they've never been taught, but perhaps because they're just not ready to understand it until about the time that they graduate from college. So while this is for everybody, it's really targeted for those of you who will be maybe leaving us in the next couple of years to go out and become adults in the adult world. I will say that it's encouraging that people are interested in this topic because especially in today's world with the coronavirus, it's going to be really important to understand about loans and credit cards because I'm guessing a lot of people are using their credit cards a lot right now. So let's kind of go back and talk first about what a loan is. So if you go and get a loan, let's say from you finance your car, you buy a new car, maybe it's a new to you car, or you buy a house, or you buy anything where you sign a loan agreement. Basically what you're doing is you're getting money for some limited amount of time, 5 years, 15 years, 30 years, whatever the time frame is, and the institution that's going to lend you that money gives you that money and says, here, let's say you're buying a car and it's a loan for $15,000. Here's $15,000. We want you to pay this back over, let's say, 5 years, and you're going to be paying whatever the interest rate is. They're going to tell you on the front end, you're going to be paying $15,000 back plus interest, because the interest is how the financial institution or entity that loans you that money actually makes money. So it's not just out of the goodness of their heart that they're going to give you this money and say, here, $15,000, pay it back, just $15,000. You're going to pay way more back than that. We'll talk a little bit later about how the interest is computed and the monthly payments and those kinds of things, because it's a little bit shocking how much you pay in interest if you aren't paying attention. So the loan is really, they're giving you some money for your use for some limited amount of time. You're going to pay it back plus interest. So think about a credit card. Basically, it's just a loan to you. If you go to a store and you give them your credit card instead of paying cash, and Professor McCondy talked last week about the psychological situation going on. When you give somebody cash, there's like a physical parting of the money from you in your hands to the cashier, if you will. But if you flip out a credit card, it's like it's not real. It's like it's not real money. I remember when I was a child, we really didn't have credit cards back then, but I remember saying to my mom when she would say, well, we don't have any money, I don't have any money, I would say, write a check. Because I didn't understand that the check was basically money. Well, today it's kind of the same thing. My children, when they were little, and I would say, we don't have any money, they would say, well, just use your credit card. Because they really didn't understand that that was basically giving my credit card meant that I was getting a loan for the use of this money for some period of time, and I had to pay it back plus interest. So when there are people in the world that really don't think that credit cards are a good thing at all, and you may know of some of those, maybe it's your parents, maybe it's relatives, there are some big financial gurus who feel that same way as well. I don't think credit is inherently bad, but I think the abuse of credit is really bad. So if you understand credit and you make it work for you, it's a good thing. So for example, if you get a credit card, and we'll talk about that in just a second, but if you get a credit card and you pay it off every month, so you go out and you charge, you go to the restaurant, you charge, you go to the sporting goods store and you charge, you go to Walmart and you charge, or wherever, and then whatever the bill comes in at the end of the month and you pay off the balance, the full balance, basically and you're getting the use of that money as a loan for a short period of time with no interest paid. But the problem becomes when you start charging and charging and charging and only pay minimum payments or not the full balance. You are basically giving that credit card company money, the issuer of the credit card money called interest, for the use of that loan beyond the month or so that you get to pay it off in full. So that's where the problem comes in. So let's talk a little bit about credit scores for just a couple of minutes. So a credit score is also called a FICO or an FICO score, is a way that credit card companies or anybody who issues a credit card will look to see what your credit card score is to see if you're a good credit risk. So the top of the range is 850. So a higher number is good in this situation. The higher your credit score, the better your terms or your interest rates are when you get a loan or a credit card. And the reason that is, and obviously the vice versa is true too, the lower the number, the worse your rates will be, and the more money you'll pay in interest for the loan of money. And the reason that is because you're not a very good credit risk in terms of the credit card company is worried about you repaying the loan. They're worried about them getting their money back if you have a lower credit score. If you have a high credit score, if your credit score is 800, they're probably saying, yeah, I'll give him all the money he wants because he's a really good risk to pay it back. So how is a credit score calculated? Well, you can Google this. There's a lot of information online. I'm very briefly going to go through it. It's got 5 components. The first thing is your payment history. So do you pay your bills on time? If you have a credit card and you always pay on or before the due date for your payment, then that's really good. But if you're perennially late, every month you're a couple of days late, 2 weeks late, that dings your credit score and brings it down. So that's something that you can start doing now if you have a credit card. Never be late with your payments. Debt. How much debt do you have on your credit right now? And so there's debt, there's different kinds of debt, but we're talking primarily debt on your credit cards and any loans that you've taken out from a bank or any other financial institution. Are you carrying a lot of debt vis-a-vis how much money that you make? Because if I've got credit card debt of, let's say, $20,000 and I'm making $35,000 a year, I'm not probably going to be able to repay that $20,000 or that loan or my credit card payments easily because I don't really have a lot of income. If I'm making $500,000 a year and I've got $20,000 in credit card debt, that's a little different story, right? But you're looking at the debt that you're carrying vis-a-vis your income, and lower is better, or a smaller percentage is better. The duration of your credit history. So many people will say, well, I'm going to wait till I get out of college to get a credit card. That's a strategy, and you can certainly do that. What you might think about doing is while you're in college and maybe your parents are still supporting you. I know not everybody's parents are supporting them, but go ahead and get a credit card, maybe with co-sign with one of your parents, and start putting charges on your credit card. So you might put a gas, fill up your tank once a month, and you put that on your credit card, and maybe you put 1 or 2 other purchases on your credit card that you know you can pay off at the end of every month. Again, payment history is important, right? So you pay it off every month, and what you're doing over a period of years is you're developing a credit history, and you're showing that over time you pay your bills on time and that you can be relied upon to pay those bills back. And so that's the third component of this FICO score. The amount of new credit. So you're at a local retailer and they say, you know, Miss Susie Q, if you sign up today for a credit card, we'll give you 10-15% off. And you're like, oh man, that sounds good because I need $100 off this $1,000 purchase I'm about to make. So maybe you decide, okay, I'll get this credit card, and you fill it out very quickly and they give you this credit card, and that's okay. But the problem is when you do this over and over and over again, and it looks like that you are getting too many credit cards, and again, we know that most people aren't very disciplined about their credit, so you're getting too many credit cards. That looks bad to a person who's looking at your credit score because and evaluating your credit, because they're saying, well, that's too much temptation for most people. If they've got 3 or 4 credit cards, they're much more likely to go out and spend, put charges on each one of them and not be able to pay it back. So the amount of new credit is important. If you space these things out every several years and you show good credit repayment, then it's fine in 3 or 4 years to get another credit card. But right now, if you're getting 3 or 4 in a year, that's negative. And then there's the types of credit you have. So good credit would be credit like with you get a mortgage, you buy a house. That's really considered good credit. But revolving credit, not so much, where you have to pay it off every month, like at a Belk or a Macy's or something like that. Again, it all matters. So 5 different things come up to make up your credit score. So again, the reason that's important is because you get a better loan rate or a better interest rate for your credit card the higher your FICO score is. And so that's why it's important to pay attention to all of this at this point. So let's talk a little bit about credit cards and how they work in terms of interest. And this is the thing when I teach this in a class that I teach every fall, most students are just flabbergasted by. So credit cards, they have an APR, an average purchase credit card interest rates. And so I decided to go and check today. This is data from March of 2020. And there are articles out there in Google, if you Google, that will tell you what the average credit card interest rates are annually. And so you might know that you can get a credit card from your bank or financial institution, credit union, whatever, or you can get some specialized credit cards. So you might get one that's travel related or airline related or hotel related, business credit cards, cashback credit cards, and student credit cards. And they all are out there for you to consider. So what I did is I pulled it up, and I'm happy to send this to any of you who reach out to me, but this basically shows you that the low interest rate and the high interest rate. So let's say a travel credit card. You decide you want to get a credit card that will give you points so that you can go on trips to, Australia, New Zealand, Europe, wherever you want to go after you accumulate a lot of points. And so that would be a travel credit card. So the low rate on this is 15.62% a year, or annually, and the high rate is 19.24, where the overall average is like right around 16. And you can see on here that the low for any of my credit cards here is 13.12%, and that would be a business credit card. Up to the high rate would be on this second sheet, which not surprisingly is cashback credit cards and student credit cards of 22.99 and 22.62%. And the reason that there's such a range is it goes back to that credit score that you have. So if you're not at very good credit risk, you're going to pay more interest. So let's just do an example for a second. You have a credit card. You've shopped around and you've decided you're going to get a credit card, and your credit card is 18%, which is kind of within the realm of reality here. So you decide you've got this hot little credit card in your hand, and you're going to go down to Walmart or Best Buy or somewhere because you've decided you need a new phone or a new computer or something. Let's just say it's a computer. You don't really need a new computer, but you've decided you need the latest and greatest because yours is too slow, too whatever. All right? So you go down and you whip out your credit card. Again, the psychological impact of giving a credit card is not the same as if you even wrote a check, and certainly not if you gave them $1,000 cash, but you're like, I've got to have this. So you put $1,000 credit or charge on your credit card. Your first bill comes in. It's got a minimum payment due, and then obviously the full balance. The full balance is $1,000, but it's going to tell you what the minimum payment due is. How is that minimum payment calculated? Well, for most credit cards, what they do is they say, we're going to charge you, minimum payment is either between 2 and 4% of your principal balance for that month. So our balance right now is $1,000. So let's just go the extreme case, the worst case scenario. Let's say it's 2%. Well, 2% of $1,000, math brains, $20. So the minimum payment due is $20, and so you're like, oh, I'll just write a check, or I'll do my payment for $20, and then I'll only owe $980 next month, right? No, that's not the way it works. Of that $20, some of that goes to interest, again, the right for you to use that money for a while the rest of it goes to principal. So how does that figured out? Well, what you do is you say, what is my annual percentage rate? And I said earlier it was 18%. You divide it by 12, which is the number of payments you'll make in a year. And in this case, we come up with 1.5%. So then we go back to our principal and we say, okay, 1.5% times $1,000, that's $15. So of that $20 minimum payment, $15 of that $20 goes to pay interest on this loan or this credit balance, which is like a loan. Only $5 goes to pay for principal. So next month, if you only pay the minimum, $20, next month your balance is going to be $995. And so on and so on and so on. So guess how long it's going to take you to pay, and this is assuming you put no other charges on that credit card. So you make one $1,000 charge and you're just paying minimum payments for a long, long time. Any idea how many months and or years it might take you to pay that thing off? Well, I'll tell you. If you only make the minimums, it's going to take you 151 months, which is 12 years and 5 months, to pay off that credit card. And again, you've never used it for another purchase. So you're going to pay for that computer for 12 and a half years essentially. And even worse, you're paying way more than that $1,000 it costs you to purchase the product. The interest alone, if you make the minimum payments, is $1,396. So add that up. You're spending $1,000 for your computer, $1,396 for your interest. So that computer ultimately takes you 12 and a half years to pay for and costs you $2,396. And most of us are not going to be even using that computer in 12 years, right? It's going to last us 4, 5, 6, 7 years, something like that, and it's going to be out of whack by then. So we're paying for something we're not even using for that amount of time, and that's just not a smart decision. However, let's say that you say, gosh, I need that computer. I really need that computer. And you go down and you whip out your credit card at Walmart, Best Buy, wherever, and you give it to them, and you say, because you understand credit, and you say, well, I can't pay all of this off next month because I just don't have that kind of income, but I'm willing to pay $100 a month until I pay this thing off. How much then would this thing cost me? How long would it take me to pay off? And so if you pay it $100 a month, it's going to take you 11 months to pay off. You're going to pay interest of $91.62 for a total of right at $1,100 for that $1,000 purchase. And you might say, well, that's worth it to me. I'm willing to pay $1,100 for a $1,000 purchase and pay it off in a year versus paying the minimum payment for 12 and a half years and not even being able to use that computer in probably 8 to 10 years from now, right? So sometimes credit may make some sense to you. The best advice, though, that I would give you is, as you're looking around for credit cards, look for a good interest rate, a good APR. The lower the better. That's going to be dependent on your FICO score, obviously. If you can get a good credit card, every month if you can pay it off, that's ideal. But even if you can't pay it off every month, if you will make much larger payments than the minimum payment, it may be worth that to you. And the last thing I would tell you is that there's a book out there that I would encourage you to take a look at. It's called Why Didn't They Teach Me This in School? It's a 99 Personal Money Management Principles to Live by a guy named Kerry Siegel. And I use this book in my Life and Career After UMW class, and it's got a lot more information in here other than just about loans and credit cards and all. But it's got really good information about loans and credit cards, and so if you want to take a look at that, it'd be great. Mr. Siegel actually wrote this book because he wrote all of these little snippets for his own children, and they said, Dad, you really need to put this in a book because most people don't know this. Mr. Siegel recently just started doing podcasts. And so while you're enjoying the coronavirus flexibility of your life, you might want to go on and look up his information. The last name his first name is Cary, Cary. Last name is Siegel, Siegel. And you can go on, and he's got like 5-minute to 10-minute or so podcasts about a lot of these topics. So that's it for today's Money Matters. Hopefully you've learned a little bit about loans and credit cards. And while credit cards are not inherently bad, understanding them and knowing about them is very important to your financial future. Thank you. See you next week.